One of the biggest mistakes Nigerians make about tax is thinking that compliance is only when tax is payable. Under the new Nigerian tax law, that assumption can cost you penalties when you owe no tax at all. In this video, I am going to explain what registration really means, what you must file, when to file, and what happens if you don't under the new tax system. Welcome back. If you are new here, my name is Chinewale. I'm a finance manager, a tax consultant, and a personal finance coach. So far in this series, we've talked about why Nigerian tax system changed, how the new law affects individuals, and how it applies to businesses and online sellers. Today's video is where everything becomes practical, because no matter how favorable the tax rates or exemptions are, non-compliance still attracts penalties. Let's talk about what compliance really looks like in 2026 and beyond. The first thing you must understand under the new tax law is this: registration is not the same as payment. Many people assume that if they earn below the taxable threshold, they can simply ignore the tax system. That assumption is wrong. Under the new tax regime, every taxable person and business is expected to register even if no tax is automatically payable. Registration simply means that the tax authority knows who you are, what you do, and how much you earn. It does not automatically mean that you will pay tax. What determines payment is your income level, exemptions, reliefs, and deduction. But those only apply after you have registered and filed your returns. In 2026, having a tax identification number, commonly called TIN, is no longer optional. Every salary earner, freelancer, consultant, business owner, and company is required to have one. So the question most people ask is, where exactly do I register for a TIN? TIN registration is done through the Nigerian Revenue Service, either online or through its designated tax offices. Individuals can register directly on the Nigerian Revenue Service platform or the JTB portal, while businesses must ensure their registration is linked to their CAC details. During registration, you will be required to provide basic information such as full name, address, phone number, email addresses, and valid means of identification. Businesses are also required to submit their CAC registration documents. Once registration is completed, a TIN is issued and becomes your permanent tax identity. The same TIN is used for your personal income tax, company income tax, VAT, withholding tax, payee, and other tax obligation that you require now or in the future. It is also important to understand that banks, fintech platforms, and several government agencies now request a valid TIN before processing a certain transaction. This is part of the broader effort to formalize economic activities to improve transparency under the new tax system. Once registered, the next obligation is to file returns. If you are a salary earner under the payee, your employer handles the monthly tax deductions and remits same on your behalf. However, you may still be required to file annual returns, especially if you have additional income outside your salary. For freelancers, consultants, and self-employed individuals, you are required to file annual personal income tax returns, declaring your income and claiming any applicable exemptions and deductions. For businesses, filing obligations may include a company income tax return, VAT returns where applicable, withholding tax schedules, and payee returns for employees. Even where tax payable is zero, returns must still be filed to confirm exemption status. Under the new tax law, filing deadlines are clearly defined, and missing them now triggers automatic penalties. For employers operating payee, monthly payee deductions must be remitted on or before the 10th of the month following the month of deduction. For withholding tax deductions, this must be remitted on or before the 21st day of the month following the transaction. For value-added tax, registered businesses are required to file VAT returns on or before the 21st day of the month following the transaction month, whether or not VAT is payable. For individuals, freelancers, consultants, and self-employed persons Annual personal income tax returns must be filed on or before the 31st of March of the following year. For companies, annual company income tax returns must be filed within 6 months after the end of the company's financial year or 18 months after incorporation, whichever comes first. These timelines are strict. Once a deadline is missed, penalties begin to apply automatically without the need for further notice or reminders. One of the biggest changes under the new tax law is that penalties are now clear, fixed, and consistently enforced. For late filing of payee returns, the penalty is 500,000 per month for corporate employers and 50,000 per month for individual employers. For late filing of company income tax returns, the penalty is 25,000 naira for the first month of default and 5,000 naira for each subsequent month the failure continues. For late filing of VAT returns, the penalty is 50,000 for the first month of default and 25,000 naira for every additional month the default continues. For late filing of personal income tax returns, penalties are imposed by the state tax authorities and typically start from 50,000 naira, increasing with continued non-compliance. In addition to these penalties, interest accrues on unpaid tax at a prevailing central bank monetary policy rate, plus the applicable statutory margin until the tax is fully settled. What this means in simple terms is this: delaying compliance rarely saves money. In most cases, it only increases the total amount you eventually pay, not in tax, but in penalties and interest. One of the biggest mindset shifts Nigerians must make in 2026 is this: tax compliance is no longer something you do once a year in a rush. It is now a process. It involves keeping proper records, tracking income and expenses, filing regularly, and planning ahead. When compliance becomes part of your routine, tax stops being frightening and becomes manageable. Now that you understand what registration and compliance looks like under the new tax law, the next question is this: where do people usually get it wrong? In the next video, I'll walk you through the most common mistakes Nigerians will make under the new tax law, especially freelancers, business owners, and online sellers, and how to avoid them. These are mistakes that can cost you money, attract penalties, or trigger audits even when you had no intention to evade tax. Please like this video, subscribe to this channel, and turn on your notification so you don't miss the next part of this series. Thank you for watching. I'll see you in the next video. Bye.